Imagine two different businesses on the exact same street. Business A looks incredibly flashy, housed in a sleek modern building, and is valued by its owner at 10 million rupees. Business B operates out of a simple, old-school brick warehouse next door, but it also carries a valuation of 10 million rupees. If you had to invest your hard-earned money today, which one would you pick? Most people look straight at net profit. But what if both companies are currently reinvesting every single rupee back into aggressive growth, meaning their current accounting profit is exactly zero? How do you value them now? When profits disappear, smart investors look at the top line, sales. Hello friends, today, we break down the price to sales ratio and will explore how it works, when to use it, and how to avoid its biggest traps. The price to sales ratio answers a simple question: how many rupees are investors paying for every single rupee of a company's sales? The math is straightforward. To find the PS ratio, you take the total market capitalization of the company and divide it by the total annual sales. Let's go back to our two businesses. Business A has total annual sales of 5 million rupees. Since the owner values it at 10 million, we divide 10 by 5. Its PS ratio is 2. You are paying 2 rupees for every 1 rupee of sales. Now look at Business B. It generates a massive 20 million rupees in annual sales. Divide its 10 million valuation by 20 million sales, and its PS ratio is just 0.5. You are paying just 50 paise for every rupee of sales. Why do we care so much about sales if investors ultimately want profits? First, profits can be manipulated through accounting adjustments. Sales figures, however, are much harder to alter. Second, it is essential for young giants. Think of early-stage tech, e-commerce, or renewable energy firms. They often sacrifice short-term profits to capture market share. The PS ratio is also a lifesaver in cyclical industries like steel, automotive, or commodities. During a recession, a factory's profits might completely crash into negative territory. When profits drop to zero, a price-to-earnings ratio becomes completely useless because you cannot divide by a negative number. But because the factory is still manufacturing and selling goods, the PS ratio stays intact. A low PS ratio looks like an absolute bargain. But do not buy just yet. High sales do not automatically translate to real wealth. The low margin trap. Remember Business B with its massive 20 million in sales? What if we look closer and realize they are selling their products below cost just to undercut everyone else? They are losing money on every single order. This is why you can never compare PS ratios across completely different industries. A software company with an 80% gross profit margin can comfortably command a high PS ratio of 10 or 15. On the flip side, a supermarket chain with a tiny 2% net profit margin will collapse with a PS ratio that high. They need a PS ratio well below 1 to be considered a safe investment. To use the price to sales ratio safely and effectively, build a 3-step verification framework before deploying your capital. Step 1. Only evaluate a company's PS ratio against its direct industry peers, or compare it against its own historical average over the last 5 to 10 years. Step 2. Always pair the PS ratio with profit margins. Ensure that the company's operational efficiency is improving alongside its revenue growth. And Step 3. Check the debt. Massive, unsustainable corporate debt can sometimes artificially inflate sales figures through unsustainable marketing or acquisitions. The PS ratio is a powerful tool, especially when dealing with high-growth companies or cyclical turnarounds. But it is just one piece of the puzzle. Investors never buy a stock based on a single metric. They always do a 360-degree fundamental analysis before taking a decision. This video is strictly for educational and informational purposes only. I am not a SEBI registered investment advisor or research analyst. The metrics, data, and financial concepts discussed here do not constitute financial advice, investment tips, or buy, sell recommendations. Investing in the securities market is subject to market risks. Please read all related documents carefully and consult a certified financial advisor before making any investment decisions. If you found the video helpful, hit the like button, share it with your friends and subscribe to my channel.